All right, let me give you some bonus material, but I kind of feel like I need to put these glasses on because let's be honest, in the last lesson, I got pretty nerdy on you. All right, I'm gonna keep things pretty high level here, but I do wanna give you 3 different scenarios, which are gonna be super helpful, especially in the world of business. All right, so let's go first with scenario number 1 and your first bonus. Let's say we're looking at a project in a company, okay? So a company is performing projects, and we have project A and we have project B. Now, furthermore, let's say that the revenue right here that project A is generating is 100 G's, 100 grand, and project B is also the same size. It's generating $100,000 in revenue. This is just the top line. Remember, this is just the income that the business earns by selling its products and services as a part of this project, okay? But let's go down to profit. Let's say that company A earns $60,000 in profit on this project, and project B only earns $30,000. Wah, 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 right? What a loser, what a sucker project B is. Because if we look at profit as a percentage, project A earns 60% of a profit margin, and project B earns a profit margin of 30%. So here's the question I have for you. Which project would you rather have? In other words, which project is more successful? Now, if you're like most people, you're going to say project A is the winner, because why wouldn't you want more profit? You're going to earn $60,000 here compared to $30,000, right? It's a no-brainer. But there's one piece of information that is missing. And this is the bonus material that I'm giving to you because I didn't learn this until later on in my business. And trust me, when I didn't understand this concept, I lost a ton of money and I was pursuing the wrong projects. So let me explain. Let's say project A requires 2,400 labor hours in order to complete it. And project B only requires 500 labor hours to complete it. Does that change your answer? Okay, if not yet, right, you're a little stubborn one, huh? I'm just kidding. So if you look here and we take profit per labor hour, I'll just put profit per hour. So if you take $60,000 divided by 2,400 hours, guess what? We end up with 25 bucks in profit per labor hour. Now, if you take $30,000 in profit divided by 500 hours, you get $60 per hour. Now you may be wondering, Steve, what's the big deal here? You're still making 25 bucks an hour, and maybe you have multiple projects going on at the same time. What's the big deal, right? Here's the big deal. What if your overhead cost, all right, the cost to run your business are $40 per hour, all right? And what if we're referring to here gross profit, all right? So this is really our gross margin. This is our profit before accounting for overhead. Remember, on the income statement, we have revenue, cost of goods sold, gross margin, then we have overhead, then we have our operating income. So what I'm referring to here is the gross profit, right? This gross margin here before overhead. So let's say the company's overhead is $40 per labor hour, right? I'm simplifying things. Well, guess what? If you do project A, and let's assume there's no other project going on to compensate for this, you would work your way out of business, all right? Now, this may seem crazy to you, and trust me, it was crazy to me, but one day I was working with a client, he came to me and he's so frustrated. He's like, Steve, all my projects are profitable. Look at this sheet. And he showed me the spreadsheet. And sure enough, every single job was earning a positive gross profit. But guess what? He was about to go out of business. He's running out of cash and he was in a very dire situation. When I did the throughput calculation, and I took the gross profit per hour, I realized that he was earning less than his hurdle rate, right? And this is the hurdle. You have to earn $40 an hour at least to cover your overhead. So project A would put you out of business. That's why project B is more attractive, because labor is the constraint. If you don't believe me, go and try to find good employees, because this is where I found myself with my landscape company. And since this is constrained, and especially if the business is operating in a seasonal area, right, you're definitely going to be constrained. But this whole principle right here of throughput is bonus item number one that I want you to understand. It gets a lot more nuanced than that, but this is throughput. And if you don't understand this concept, you will go out of business, all right? Or at least at a minimum, you'll stay in business, but your profitability will definitely suffer. Until I learned this principle right here, my business did terribly. Once I learned this, I realized, look, I'm going to go after project Bs, right? These types of jobs, because the throughput is a lot higher than project A. I'll let my competitors fill up their schedule with project A's. I'll take project B's and I'll do a heck of a lot better. When I apply this to my business, my company radically changed its financial performance and its trajectory. All right, so that's bonus material number one, and that is what I call throughput. All right, isn't this so much fun? Yeah, I'm having a lot of fun, but I have to take these glasses off because I'm going to get really serious with you for number two. Let me do that in a more dramatic fashion. In fact, I'll take these off because we are about to get into number two. All right, this is a really interesting topic as well, because let me give you another scenario. Let's look at things on a company-wide level. So not just a project level, but company-wide. And if we just go through the income statement, we have revenue, cost of goods sold, gross margin or gross profit, OpEx, our operating expenses, and then we just simplify it and just arrive here at profit. I'm just keeping it really high level here. But let's say we have company A and company B. And let's say right here, company A earns $100,000, right? Like I said, I'm simplifying it. You're like, Steve, you really like 100 grand. I do, because it's nice and round, but you can imagine this could be $100 million, or it could be 10 million, whatever it is. Same kind of principle. So they earn $100,000. Then let's say they have cost of goods sold of 60,000 for both companies. So they don't have a gross margin problem. So here they arrive at $40,000 in gross margin profit, but we also have to account for operating expenses. And let's say this company has a pretty lean overhead of $20,000 operating expenses, and therefore take 40,000 minus 20, and we end up with 20 G's, right? 20 big ones. Let's say this company, they have more overhead, they're not as efficient, and therefore they have $10,000 in profit. Which company is performing better? Company A or company B? Now you might be thinking, Steve, you're totally going to trick us on this one, just like you did in the last example. Or you may think, I don't like A because in the last example, A was the bad answer, so I'm going to go with B. Well, unless you have an answer for this, right, then you're just guessing. But let me just help you to not guess and to get more detailed on this explanation. So you have A and B. But remember, profit is not the same thing as cash flow. In fact, 70% of companies that go bankrupt are profitable when they close their doors. Remember that stat? So how do we get down to free cash flow? We have to account for working capital, which is the difference between your current assets and current liabilities. I'm just simplifying here. We also have to account for CapEx, which is short for capital expenditures. And this just represents the amount of investment made in property, plant, and equipment. So you're buying trucks or machinery, or you're investing in a building. This CapEx is capitalized on the balance sheet, and it's not recorded up here in your income statement. So we have to account for this to get the free cash flow. Then we arrive at free cash flow. Now there's some other nuances in here that I'm not going to bore you with the add back of depreciation and amortization. That's more advanced and covered in other courses. But let's just keep things really high level so you can understand the essence of what I'm getting to here. Because remember, company A looks more attractive from a profitability standpoint. And this is where the majority of leaders focus their attention, on the bottom line right here, okay? but I'm going to help you to get to the next level. Let's say company A has working capital of, let's just say $15,000, right? So this is the amount of money that's tied up in working capital to run the business. And then let's just say they invest $10,000 in capital expenditures, okay? Therefore, we have to take $20,000 minus our $15,000 in working capital minus the $10,000 in CapEx, and guess what? We arrive at $5,000 of negative free cash flow. Company B, on the other hand, let's just say they have working capital of $5,000, and let's say they have $0 in capital expenditures. They actually have $5,000 in positive free cash flow. Now, does this change your answer? Right? Perhaps. Because look at this. This company, yeah, they have higher profits, but they require a lot more in invested capital in order to run the business, and therefore they're running at a cash deficit. If they continue to do this for too long and they can't straighten this out, guess what? They go bankrupt. This business, on the other hand, maybe they are capital light, so they don't require a lot of investment in CapEx, and they do a really good job of managing their working capital, and guess what? They're able to generate cash. So it's all about cash, baby. I want you to remember that. Sorry to call you baby there. Hopefully I didn't offend you. But I want you to remember it's not about profit, it's about free cash flow. And understanding the flow here is really important, and that's why this is bonus numero dos. There's a white boy for you speaking some Spanish. Okay, that's bonus number 2. But we're not done yet. We have one more. Let's look at company A and company B. And let's just say company A has the 100K in revenue, I was talking about in the last example. And let's imagine their profits roll out like this. Company A has 20 grand in profit, and company B has 20 grand in profit. Which company is the better performing business? Now you may be looking at this like, what the heck, Steve? You just wrote the same numbers twice. You're right, I did. Because look, if we're looking at these two companies, we may think, hey, they're both successful. They're both earning profits, $20,000 in fact. So I would take either one, A or B. But there's one missing element, of course, right? Underneath profit, remember when we were talking about return on invested capital, which is your net operating profit after tax divided by your invested capital? Okay, I'm going to keep things really high level here. But let's just say the amount of invested capital that goes into company A to make it work is $1 million. In other words, they have working capital and their net property, plant, equipment. And these two numbers combined together is $1 million. To put it simply without all the nerd talk, let's say it takes $1 million to run this business, to float the current assets, to float the current liabilities, and to invest in the equipment, the machinery, and everything else to run the business. This is the amount of capital that's trapped in the business to earn profits, in other words. Okay, $1 million it takes to run this business. Let's say with company B, their invested capital is only $200,000. They're capital light. They don't require as many fixed assets to run their company. And therefore, if we go and compute return on invested capital, and we take this $20,000 divided by $1 million, guess what? We end up with 2%. Over here, we take the $20,000 divided by the $200,000 invested capital, and we arrive at 10%. Now let me ask you this. Which business is more attractive? You may say, Steve, it doesn't matter. We're still earning profit. Well, yeah, you're earning profit, but you have $1 million of your money in the business in order to earn $20,000. So you're earning essentially 2% on your money. Now, if you just put your money in a money market account right now, you can earn like 4% based on where we're at right now, the time of recording this video. Okay? So you could earn more money, take this $1 million, put it in a money market account, and you have to deal with all the headaches of customers and product quality issues or employees or whatever it may be. And over here, you're earning 10% on your money because you only put $200,000 in. So imagine if this is your money, you could take the $800,000, the delta between company A and company B, and you go start another business, or you go invest in stocks or real estate. So you have to consider return on invested capital. And this is bonus number 3. And in this bonus section, I just wanted to point out 3 different scenarios of why financial literacy is so important. Number 1, I walked you through throughput. Number 2, I walked you through free cash flow. And now I showed you why return on invested capital makes a big difference in a business, okay? Because if your cost of capital is greater than your return on invested capital, then you're ultimately losing money, okay? So that's why these concepts are important. Now look, I don't expect you to know all these things just because I explained them really quickly on my whiteboard in the starter course. What I want to do is I want to show you how finance can be exciting, and it doesn't have to be all complicated with these Greek symbols and complicated formulas. Instead, it's just understanding the story behind the numbers can empower you to make better financial decisions. When I started out, don't feel bad if you're struggling right now or if you're lost or confused. I had no clue how any of this worked, right? This is what I'm here to do, is to educate you on this stuff, because you may be running a business. Imagine you do this for 10 years of your life or 20 years of your life. You're running your company and you're like, yeah, check, I'm good, we're earning profits. Only to find out that you don't even have a business you could sell. Or maybe instead of a 5x multiple, you can only sell it for a 1x multiple or a 2x multiple or a 0x multiple. What if instead of the 15% return on your money, like I showed you in that previous example, what if you only earn a 3% return or a 2% return? That could be a major difference in your financial life. And that's what I want you to understand, is that by building financial skills, I'm not talking about being a nerd, doing all the debits and credits like I was talking about. I'm talking about just understanding the basics, the fundamentals of finance. You're going to be in a position to drive greater value in business. And guess what? If you're driving greater value in business and you own it, there's more upside for you. If you're driving greater value in the business and maybe you're just a manager, you're going to get promoted, right? Because you're going to know finance and how to pull certain levers to get better results, right? So wherever you are in your path, whether you're a business leader, a business owner, or an aspiring financial professional, I'm just so glad that you stuck with me through all these examples, and hopefully you're sharing some of the enthusiasm. Let's go on to the next lesson now.